You open your 15-minute chart, you spot a single candle, and you draw its high and low. This creates a range. Now you simply wait and watch what happens next. If the next candle breaks the range and then closes back inside it, that's a liquidity sweep, and that becomes your signal. Now switch to the 1-minute chart. You'll notice the same thing. The high and low of that 15-minute candle now form a range on the lower time frame. Price breaks below the range and then closes back inside it, forming a liquidity sweep. That's your entry. You enter at the close of the candle that moves back inside the range. Your stop loss goes below the range, and your target is the next key level. Look at what happened. The market moved straight to the target. Now let's look at another real chart example. Again, start with a single candle. Draw its high and low to form the range. The next candle breaks above the range, but then closes back inside it. Now switch to the 1-minute chart. Observe what happens. Price breaks the range, then closes back inside it, creating another liquidity sweep. You enter at the close of the candle that moves back inside the range. Your stop loss goes above the candle, and your target is the next high. Look at the result. The market reaches the target as expected. Let me show you in 30 seconds how to trade the stop loss hunt strategy. You identify a key support level. Price hits the level and reverses. It pulls back, comes back again, and reverses again, so the level is clearly respected. Now price approaches the level one more time. A rejection candle appears at the level. At this point, you do nothing. You simply wait and observe what institutions are doing. Look at what happens next. Price suddenly breaks below the level and then closes back above it. That's a clear stop loss hunt. Now you enter at the close of the candle that hunted the stop losses. Your stop loss goes below the candle, and your target is the next key level. Look at the result. The market moves up exactly as expected. Now let's look at a bearish example. Price hits this level and reverses. It hits it again and reverses again. That forms a clear resistance level. Now price approaches the level once more. A bearish candle appears, and retail traders start selling. But look at what happens next. Another candle forms. It suddenly breaks above the resistance level, but then price closes back below it. That's a stop loss hunt. You enter at the close of that candle. Place your stop loss above the stop hunt candle, and your target is the next level. And look at the result. The market moves straight to the target. Now let's move to the next scalping strategy. Look at this 15-minute chart. You can see the market forming one strong bearish candle, followed by another one. At this moment, the market is not just moving down, it's entering a state of fear. Traders who bought earlier are panicking, stops are getting hit, and emotions start to take control. Now switch to the 1-minute chart. Here, you don't enter immediately. You wait for a signal that shows resistance to that fear. And that signal is a bullish pin bar. Look at this candle. It forms right in the middle of that panic. It's like a small pocket of strength inside a fearful market. But you don't trade the pin bar itself. You wait for something more powerful. You wait for the failure of the pin bar. Look at what happens next. The market breaks through the pin bar. Fear takes over again. The small resistance disappears, and that's your entry. You enter at the close of the candle that breaks below the failed pin bar, a stop loss above the failed pin bar. Ride the momentum and scalp a few quick pips while fear is still controlling the crowd. Now look at another example. This time, the market is trending up. It forms one strong bullish candle, followed by another. Here, the market is in a state of greed. Traders are chasing the move. Everyone wants to buy before the price goes higher. Now switch to the 1-minute chart. Again, you don't enter immediately. You wait for a signal that shows resistance to that greed. And that signal is a bearish pin bar. Look at this candle. It forms against the bullish pressure. It's like a small wave pushing back against the crowd's excitement. But once again, you don't trade the pin bar itself. You wait for its failure. Once the failed pin bar gets broken, you enter right at the close of the candle that made the breakout. Place your stop loss below the failed pin bar and scalp a few quick pips while the crowd is still trapped in its emotional state. And look at what happens. Now let's move to the next strategy. The supply and demand scalping strategy. Look at this chart. You can see the market making a strong move up with large bullish candles and almost no pullback. This kind of move usually comes from institutions. Retail traders don't create moves like this, and the beginning of that strong move is called a demand zone. This is the area where institutional buying started. Now watch what happens next. Price eventually retraces back to that zone, and as soon as it touches the area, the market gets rejected. Buyers step in again, and price moves up strongly for a second time. Now look at another example. Here, the market makes a strong move down with large bearish candles. This type of move is also driven by institutions, and the beginning of that drop is called a supply zone. Now watch what happens when price returns to that area. As soon as price reaches the zone, it gets rejected and drops strongly again. Why does this happen? Because these are institutional zones, areas where large orders were placed before and where unfilled orders may still be waiting. But not every zone is strong. So how do you know if a zone is truly institutional? There are 4 simple criteria. A strong, impulsive move away from the zone. Large candles with little or no wicks. The zone is fresh and not tested multiple times. A clear break of market structure after the zone. A good risk to reward ratio. When these conditions are present, the zone is more likely to be institutional. Look at this 1-minute New Zealand dollar to US dollar chart example. As you can see, price forms a strong bullish move. The beginning of that move creates a demand zone. Now let's check if this is a high-quality demand zone. The move is strong. The candles are large. The zone is fresh. There is a clear break of market structure, and the risk-to-reward ratio is attractive. Now look at what happens next. As you can see, once price retraces back to the zone, it gets rejected, forming a clean pin bar. So here, you place your entry at the close of the pin bar with a stop loss below the zone and the target at the next level. Look at what happens next. The market reaches the target as expected. Now look at a bearish example. Here, the market forms a strong move down, creating a supply zone. Price retraces back into the zone and gets rejected. That's your entry. Stop loss above the zone, target at the next level below. And once again, the market moves in your direction. But remember, this strategy is not a holy grail. You need to use top-down analysis, trade with the higher timeframe trend, and apply proper risk management to stay profitable in the long run. Now let's move to the next scalping strategy, the break and retest setup. Look at this 5-minute chart. The market is clearly trending up. Here, price makes an impulsive move higher and breaks above this resistance level. Then price pulls back. And once it returns to the level that was broken, look at what happens. The level now acts as support. Price gets rejected and moves up again. Why? Because this is how an uptrend works. First, you get an impulsive move where buyers push the price higher. Then those buyers start taking profits. Price retraces, creating a pullback. But that pullback usually returns to the previous resistance level that was just broken. And once price reaches that level, it is now seen as a good price to buy. So buyers step in again and a new impulsive move forms. So how do you trade this? Look at this example on the 5-minute chart. Price breaks above resistance, then pulls back to the level. As soon as price rejects the level, that's your entry. You place your entry at the rejection candle, your stop loss below the level, and your target at the next resistance. And as you can see, the market moves up as expected. Now let's look at a bearish example. Here, the market is in a downtrend. Price makes an impulsive move down and breaks below a support level. Then price retraces back to that level. But this time, the old support becomes resistance. Once price reaches the level, it gets rejected and drops again. That's your entry. You enter at the rejection, place your stop loss above the level, and target the next support. And once again, the market moves in your direction. This strategy is simple. Wait for the break, then wait for the retest, and only enter after the rejection. The market makes a strong bullish move, creating a fair value gap in the process. Later, price retraces back into that gap. And look at what happens. As soon as price enters the zone, it finds support and moves up again. That's your signal. You place your entry at the rejection inside the gap, your stop loss below the zone, and your target at the next resistance. And the market moves up as expected. Now look at a bearish example. Here the market drops aggressively, creating a bearish fair value gap. Later, price retraces back into that area, and as soon as it reaches the gap, it gets rejected and moves down again. That's your entry, stop loss above the gap, target at the next support level. And once again, the market moves in your direction. And that was the final scalping strategy. Now you've seen the complete framework. The key is not to use all of them, but to master one or two and apply them with discipline.